Hello everyone. This is Microsoft Mark speaking on behalf of Fred Duckworth, here to explain for you how to interpret Fred's Forex market forecasts going forward, at least for the foreseeable future. First, understand that Duckworth regards moving averages as the best atmospheric barometers, if you will, for predicting the direction in which an exchange rate might ultimately be headed. Accordingly, Fred will be referring to the global baseline as the measure dictating whether he will be interested in buying or selling a particular asset in the context of day trading, with a baseline defined as a moving average that serves as a guide or roadmap, clarifying whether a given asset is bullish, bearish, or neutral for a specific time period. Also, one of the main differences between Fred's system, which he calls numerical price prediction or NPP, and the standard approach to interpreting financial charts is that the intervals which Duckworth uses to quantify his moving averages are based on time rather than on periods. In other words, you will never hear him refer to the 10, 20, 50, 100, or 200 period moving averages. Rather, he will reference the 5-minute baseline, or the 2-hour price range envelope, etc. This is because trading with the clarity and precision he requires demands that specific temporal values be assigned to each moving average to answer questions like, in which direction and by how much is price moving every 5 minutes? Or every 30 minutes? Or every 4 hours? Or even every day? The goal with these baselines is to arrive at something reflective of flight dynamics, where the laws of physics explain how forces act on vessels to govern their performance, stability and control to ultimately determine their velocity and attitude with respect to time. So, in the same way pilots are aware that an Airbus A350 will lift off the ground by angling upward at 2 to 3 degrees per second with a maximum angle of 10 to 15 degrees, NPP informs traders as to the parameters dictating whether an asset is rising or falling from the perspective of a day, swing, or position trader. It also incorporates the idea of cycle theory, which holds that cyclical forces, both long and short, drive price movements, and can be used to anticipate turning points. Not to mention its compatibility with Edgar Peters' fractal market hypothesis, which views financial markets as fractal in the sense that they follow cyclical and repeatable patterns. Once consisting of fragmented shapes that break down into parts which then replicate the shape of the whole. Accordingly, Fred will be looking to enter positions when price is positioned or located on the contrarian side of the global baseline and is exiting a peak or trough, as appropriate, of one or more cyclical waves formed in the wake of price action, as suggested by the frequencies and magnitudes of the relevant oscillations. That's pretty much it, in a nutshell. So, until next time, see you then. Bye.